Hey everybody, afternoon. We will get started here in about 30 seconds or so. Thanks for jumping on here right on time. Actually a little early. Don Wenner here, joined by my associates Rich, Larry, and Kyle, jumping on as well to be paying attention to you guys. Type in your questions in, so please type them in the chat box as we get going here, or in social media, wherever you're tuning in, and they'll make sure to grab them and get them answered for you here this afternoon. Today is I'll call almost a monthly version now, as we went from doing these weekly and the kind of the depths of COVID to now doing these every 3 or 4 weeks. We're going to give you some updates from the version, or the last time we met about 3 weeks ago, on the big acquisition that we're working on. Tell you about some of the other deals that we have coming up, what's happening here at DLP, some of the big milestones we've just achieved or about to achieve, and give you some sense of what's happening overall in the real estate market today. So with that said, for any of you guys who are new to DLP, I'm going to go ahead and kind of give you a quick overview. And even of those of you guys who are veteran investors here at DLP, you'll notice this slide's a little different than previous versions. And we put this together here recently to kind of better illustrate all the things we do at DLP, how everything works together. So I think you'll find this helpful even if you've been invested with us for a while. So here at DLP, our parent business is DLP Real Estate Capital, that you'll see over there on the left of your screen. And then the engine, though, even though that's the parent business, the engine here at DLP is DLP Capital Partners. That's our investment management business. That's the company here you guys are hearing about today that offers the various investment vehicles I'm going to touch on in a few moments. We take that capital that our phenomenal investor base entrusts to us, and we take that capital and we lend it out through DLP lending to successful full-time real estate investors. We give them short-term loans to renovate or build new single and multifamily properties. We also invest the capital specifically in the housing fund into acquiring rental communities and then managing those properties, doing the property management, construction management, asset management, all through DLP Real Estate Management, you'll see here. All of the apartment communities we own, rental communities, not just apartments, single family communities as well that we own, we brand them all as either dream communities, live communities, or prosper communities. And dream, live, prosper is what DLP stands for. Dream are sort of our higher end, what some would call sort of class A communities. Prosper are our class B communities. And then live are kind of our workforce housing. Generally don't have a lot of amenities, but very affordable rental communities. That's how we kind of distinguish our branding throughout our portfolio and the services that we provide. And then you'll see here under DLP lending, we have Alliance Servicing, which is sort of asset management for loans. That's our loan servicing company that services the loans, make sure we collect our payments, get construction draws out to our borrowers. Then we have Alliance Property Transfer, which is our in-house title company. And then over here on the left, you see DLP Realty, our first company, which really is where we started investing capital, which was offering home sellers solutions to sell their home and be able to invest capital into acquiring homes from homeowners, turning around and renovating them and selling them, offering them, we call it through DLP offers, offering unique offers to take the risk and the challenge and work out of selling a home. And then the newest companies you'll see here on the screen are DLP Elite. DLP Elite is a membership platform we've been running for essentially for the last couple of years, where we bring in top real estate operators. These are the types of operators that we lend capital to who are scaling real estate businesses similar to DLP. Guys who are building portfolios, guys and gals who are building portfolios of single family, multifamily homes. And we're helping them scale their business, certainly through lending them money, investing with them, but helping teach them how to scale their business, how to implement what we call DLP, the Elite Execution System, which is the way we've grown all of our companies and been able to have this 60% growth year over year in a very disciplined manner. We come and we teach operators on how to do that. And actually, right after I finish chatting here with you guys today, I have a call with all of our Elite members, again, helping focus them on scaling their businesses, taking away risk through discipline and structure, and building great organizations with great people. And then our newest business line, which you're going to hear me talk about in a few moments, where we're having our first kind of kickoff event, is called our Prosperity, Family, Wealth, and Legacy membership. And this is a membership focused on investors like you, people who are looking to build their wealth, build legacies, build succession planning, tackle things like tax planning and estate planning and philanthropy. We're going to have a really cool event. You're going to see a little bit more information I'm going to talk about here, kind of kicking off this membership in this group in November. We already have about 50 families joining us, and it's going to be a really, really great time. But I'll talk more about that in a moment. So those are all the businesses and how they work together here at DLP. At the center of these businesses is our people. We're knocking on the door of 400 team members here at DLP, driving results through those businesses I just showed you. We know our greatest asset, no offense to all of you who've entrusted your capital with us, our greatest asset here is not our capital, but it's the amazing people that we've built here who execute each and every day. Driven all by the same purpose: dream, live, prosper, passionately creating prosperity through real estate, sharing a shared mission, which is leading and inspiring the building of wealth and prosperity with our partners. That includes you as our investors, as well as our team members, the borrowers we lend to, through relentless execution of innovative real estate solutions. And we allow our 10 core values you see there on the top and the bottom of your screen to drive all of our decisioning, drive the types of people we hire, how we make hard decisions, how we evaluate our team members are based upon these 10 core values. These 10 core values and this mission that we're on has led us to knocking on the door here once again of hitting our 1,000th investor. So hopefully somebody here in this webinar with us right now will get to take the milestone here of being our 1,000th investor. We actually are 7 investors away from 1,000 investors as of this morning. That number may have changed since this morning, but that's the number Larry gave me this morning. We had 7 to go. We're at 993 investors. That's a pretty cool milestone for us. And that's 993 investors, not ever invested with us. We're invested with us right now. So pretty cool, which hardly any investors have ever left us, which is one of the things we're most proud of. To take all this capital coming in from the soon-to-be 1,000th investor and everybody else who've been investing with us here over this year. We've been focusing really hard in growing our lending business. We had an excellent month of August. We funded $38.5 million worth of loans, our best month of the year, maybe our best month ever. If not, it's number 2. And we funded $21 million in lines of credit to borrowers. So really solid month of August, which I'm very confident we're on pace to beat here in the month of September. We're also busy not just on the lending side of our business, we've been busy on the acquisition side as well. Our next acquisition is going to be this community here, if all goes well, which is 353 apartments in North Charleston, South Carolina. So coincidentally, our last acquisition was in South Carolina, in a different market, Port Royal, but an hour and a half or so north here. North Charleston is our next acquisition, which is Pepper Tree Apartments. This is a community built between 1983 and 1989 on the north side of Charleston. And great growing market. Charleston, if you've never been there, is an awesome, awesome place. This is a community that most of the community is original, meaning the apartments are basically in the condition of when they were built in the 80s. About 60 of the apartments out of 350 have already been renovated, and we're essentially going to follow that business plan. And we are expecting to generate over 25% return on the improvements we do in the apartments, coming in and putting new flooring, new countertops, new cabinets, new lighting, as you'll see in a moment. So we're going to come in here and follow through with tweaks, a proven value add opportunity that already was started by the previous owner. We're going to capitalize on strong demographics, strong incomes in this area, very, very strong submarket, big employment growth in the area, see from likes of Volvo and Mercedes. This community already has good occupancy, 97% occupancy, I believe, through the end of July. So good occupancy, but good opportunity to grow revenue and better manage expenses as well. Here's some pictures of the community. So brick construction. We can see generally, dated interiors, older, built in the 80s. Here's the pool and the little pool house, a grill area as well next to it. You'll see here, this is what the owner did. So we're going to do something a little different, but this is the owner's renovation plan from what the rest of them look like. So this is what roughly 300 units look like. This is what 60 units look like. So they came in and went from white to black appliances, all new cabinets, all new counters, in most cases upgraded the flooring to new hard surface flooring as well. So that's the interior business plan. Plus, we'll be tackling a bunch of exterior landscape and extra improvements. And we're going to be coming in there, and believe it or not, for a lot of us, this sounds crazy to say, but the community does not have central air. So we're going to be coming in there and converting these window air conditioners you see, or wall air conditioners you see here, to PTAC central air conditioners, which will be a big upgrade, especially in a warm climate of Charleston, South Carolina. All right, so that's the acquisition that's scheduled. As of right now, we're waiting on final lender approval, but pending that, we'll be closing end of this month. So that'll be the next acquisition that'll be owned by the Housing Fund. We'll deploy a large amount of the Housing Fund capital. It's not yet deployed. And then the next big acquisition here that I talked a little bit about a few weeks ago, we're calling the DLP, or Dream Live Prosper 2X portfolio. We call it that because it will 2X and double the size of our existing portfolio. So I was very hopeful when we talked about this a few weeks ago that I'd be telling you today that we are wrapped up and it's a done deal. Unfortunately, we are still working to wrap up the deal. The way I try to tell myself is that, a deal of this size should be hard to get done. It should take a lot of work. It should be tons and tons of effort to do the level of due diligence and work to get this structured correctly, which I promise you we've been doing to the tune of many of hours a day by many of us working to get this deal finalized. Meaning get the final stage of the contract. This is an acquisition of the business as well, the underlying entities, an M&A style transaction. So it's a bit more complicated. So we're on the phones with attorneys daily, with seller daily, working through the details of the deal. Very hopeful we're going to get through the last points and protect our money and put ourselves in the best position to be successful and then complete the rest of our due diligence. We've been out to every community, walked all 43 of these communities in detail, done deep financial review, have lined up all of our debt. We've done a lot of work, but yet still working to get the deal finalized. Hopefully we'll have that done here in the next few days, and then we'll be able to share out all the information on the deal. But a reminder for those of you who weren't here, a reminder to those of you who were here, and those some insight for those who weren't. This is a portfolio we're acquiring over a 6 cap rate, and for a portfolio of this size and built an average of 1994 of this vintage, this quality, is a really great price. We're very confident in ability to generate over a 20% IRR on this portfolio, and really be able to drive tremendous value, tackling things like deferred maintenance, improving amenities, driving up revenue, and being, keeping every dollar accountable in this large portfolio on the expense side. This portfolio is very similar to our existing portfolio in that everything you see here in blue is what we own today. And what's in red is what's a part of this portfolio we're working to acquire. So you can see how nicely it lays out over our existing portfolio, which gives a lot of operational value and building density in these markets and having regional corporate resources who can oversee these assets, and the fact that we have deep knowledge of the majority of these markets already. So really excited about this deal. Can't wait to be able to have it fully wrapped up, be able to share all the information here. This is going to be a big deal and make up a big part of what is the Housing Fund here today. Here's some pictures of what the communities look like. These aren't chosen as the best communities or the best pictures. It's just a reasonable representation of the amenities and condition of the units, the age and of the communities that we're acquiring here. Oops. There we go. So again, middle 90s average construction, as old as late 70s, as new as 2010, I believe. But the majority is in the 90s and early 2000s. Really great locations, great affordability. Average rent is about 17% of the average household income in the market. So that's really great. That means most people in the market can afford our rents, which gives us both opportunity to bring up rents a bit, but also know that we're going to have high demand and people are going to be able to pay the rents in the market. So good amenities throughout. Average communities about 270 units in size, but they range from low hundreds to as big as about 850 units. But the majority are 200 to 350 units. This one here on the right is probably the oldest community. I think that's late 70s. but still pretty good shape. Overall, good amenities, well built when it was built back in the 70s. So the plan is for all the capital that DLP raises into this large portfolio is going to go here into the DLP Housing Fund. This is our 8th fund we've opened. It's a $1 billion evergreen private REIT. This fund already owns over 5,000 apartments, over 250 million currently, about $300 million in current value of the underlying assets. Predominantly, this portfolio is made up of very similar assets to what I just showed you in what we're looking to buy. Value add Class B communities. One of the things I wanted to highlight here in the housing fund today, and I feel blessed to say this, that really the only complaint I ever hear from investors is they want us to deploy their money faster. It is definitely the number one and really the only complaint I can think of that anybody ever brings forward is they want their money deployed with DLP immediately. And understand that desire for sure. And I wanted to share a little bit of information here because I think we've spoiled people a little bit at DLP, certainly in the returns and the consistency of those returns, but I think also in our historical ability to deploy money. So when I talk to most real estate fund managers or any private fund managers, almost everybody but DLP operates in a capital call structure, which is you commit your money. So you commit, your 250 or 500,000 or $1 million, you sign the documents, you're committed, you have to fund that money. But the manager is going to call that money from you for up to 5 years or 10 years. And you don't know when they're going to call it. It could be 3 years from now, but you have to fund that money usually within 2 weeks of when they call it. So you have to make that commitment. You don't know, A, if it's ever going to get deployed or called, or if it's going to happen in 3 months or 4 years. And that's how most private investment funds work. And reason people are willing to do that is because generally for the right investment funds, the returns are obviously much stronger and more attractive than the general stock market or vehicles that are out there in the public market. So that's very, very, very common. That's how most private investment vehicles work. At DLP, how we've historically operated is you invest today, you wire in your money tomorrow, and historically we've deployed that money in about 3 weeks. So you might wait 3 weeks to have your money deployed, but within a few weeks, it's not partially deployed, but it's fully deployed. Through COVID for multiple reasons. Number one, including it's been the craziest, most volatile market and arguably in history. Things have been moving. There's been a lot of delays and challenges and deals getting closed. It's taken us longer to get deals acquired or loans funded than typical at times. Also, we're even more cautious and more risk adverse, take our time more. So again, has led to some more time. But then the biggest reason has not been anything to do with what we're doing here at DLP. It's been that we've had record-breaking amounts of capital coming in. So what I hear again and again and again and again from investors is we've outperformed every other manager, every other investment they've been in since COVID. We have not missed our return targets, continue generating double-digit returns through the COVID environment. The negative, and really, again, the only negative I hear is it's taken us longer. It's taken us upwards of 60 to 90 days to fully deploy money. Sometimes we partially deployed within a few weeks, but it took us to fully deploy 60, 90 days. So we can operate a capital call structure. We won't make you wait for 3 years or 5 years, but we can operate on a capital call structure so you can keep the money wherever you have it today and wait for us to call that capital. But in the scheme of things, it's a very short amount of time. And to kind of illustrate it here on the housing fund, a 1-year return, if we just hit our target in the housing fund on a $100,000 investment, a 12% return is $12,000. You look at what you'd earn if that money sat in a CD or a bank account or a mutual fund or even the S&P. If you're optimistic, how much you'd earned in a year versus how much you had in a lending fund. Again, not even factoring in all the tax benefits and the fact that we're likely to exceed our return targets and so forth. You see how much you earned there in a year on the left of your screen. Then you see if it took us 30 days, 60 days, or 90 days on a $100,000 investment, how much money you lose because you didn't have it deployed. $1,000, $2,000, $3,000, right? That's the amount of money you didn't earn for a few months to then earn, $12,000 plus a year for the next however many years you choose to be in the fund, because it's an evergreen fund. And you look at if you were waiting for us to deploy that money, how much money you would have lost if you were sitting in a money market account, $75 to $225. If you're sitting in a CD, $79 to $237. you're sitting in a typical, this Fidelity, one of the better performing index mutual funds, $300 to $900. Or if you're super optimistic and you're willing to take the risk and you sat in the S&P 500 and you did it in the right time, $800 to $2,500. So this is the small cost at the end of the thing that we're talking about to wait to get into an investment vehicle such as the housing fund. So what I encourage you to do, if you're looking to invest with us, you're invested with, get on the wait list. Be encouraged to do so as quick as possible, because what some people have dealt with is we've had $5 and $10 million commitments that have come in the last few months. And what happens for us is we must deploy money in the order it comes in. So if somebody invests $10 million, signs that document and commits to it today, and tomorrow you commit to 100 grand, you have to wait until we deploy the 10 million. That's how the fund works. So sooner you get on the quote unquote wait list, the sooner your money gets deployed. And it's a small amount of money in the scheme of things for the amount of time it takes us to deploy our money. So I want to give that little bit of color to everybody here. I'm not saying that's going to completely stop. That's the only thing people complain about, but hopefully it gives you at least a little bit of perspective and sets the foundation right when you make your investment. I understand it may take us a couple months to get you deployed here, but in the scheme of things, it's going to be well worth the wait. There's never a time where your money's undeployed after it's deployed. All right, so here's an overview of the housing fund. As I mentioned before, target of the fund is 12% plus returns net to investors. We pay out monthly distributions of a 6% preferred return before we even earn a management fee. You get all the profits before we even earn a management fee until you at least have a 6% return on your money since the day you were invested with us. And then we have annual redemption. So unlike most real estate funds, you can exit the fund next year, the following year, whenever you want, whatever's best for you, your tax situation, other investment opportunities. You're not stuck waiting for us to decide when we're going to wind down the fund and forcing you to take your money back. You choose what makes the best sense for you. This is going to be a big fund. Today, as I said, it's over 5,000 apartments, nearly $300 million in properties already today. This is going to be $1 billion fund. We're going to grow it over the years to come. I'm committed to investing a minimum of 5% of all the capital in the fund right now, over 20%. So heavily invested in this strategy, in these assets right alongside of you. We have a great independent third-party auditors at Cohen Resnick, great legal counsel, Stuart Kissel. All of our fund documents, all the information is all available in our investor portal as well. Then we have the DLP Lending Fund I'll highlight here today, and I'm going to talk about a couple of our upcoming events. DLP Lending Fund, which is also a private REIT fund, is a mortgage pool fund. So this is the side of the fund where we make loans to real estate investors, versus the housing fund is where we acquire properties like what I just went through and showed you guys. Here we're making loans to other real estate investors. We've been running this strategy for over 6 years now. We've generated over a 13% net to investors annually, with 100% of the distributions going out every month. So historically, we've generated over a 1% dividend every month with 90-day liquidity, with a 10% preferred return, meaning you earn 10% before we earn anything, including even our management fee. We've continued to generate over an 11% return even through COVID, with all of that income distributed monthly and 90-day or shorter liquidity. All right, so enough about the specific funds. You can follow up with us for more information there, which I'll give that information in a moment. I did want to touch on this prosperity membership event that I talked about a few minutes ago. This event's going to be November 12th to the 15th in Ponte Vedra. This is not a sales pitch. I promise to tell you that if you want to come join us, you need to sign up quickly. We're facing, space restrictions at the resort that we're staying at, space restrictions at the restaurants. Not only do we have 50 families already signed up, we're also, at the same time as we're having this prosperity event for families, for individuals such as yourself, we're also bringing our very best real estate operators there at the exact same time, what we call our elite events. And we already have over 40 top real estate operators and sometimes multiple team members in that organization also going to be there at the same time. So we already have an event with a pretty good sized group, and we're going to hit space limitations here in the near future. So if you're interested in joining us here, if you want to come join the Prosperity Membership, we're not charging you anything to come. You'll just pay for your travel to come in and your hotel stay. We're not charging anything for event membership, and we're going to have a pretty amazing event here. It'll be 3 days. Going to be kicked off with a dinner event on Thursday night with prospective investors joining us for that as well, local prospective investors here. We're going to have a lot of great speakers. We're going to cover a wide range of topics. You can read there on the screen. We have gentlemen like Ron Cordes, who was the founder and CEO of AssetMark, $30 billion investment manager. We have Ben Wallace, former NBA champ, Defensive Player of the Year. Is going to give an awesome speech. We got New York Times bestseller Dr. Nate Klemp coming. He's going to give a great presentation. We have some of the best CPAs and legal professionals in the world to talk on tax planning, talk about estate planning. It's going to be interesting timing because this is right after the election. So they're going to be able to give some great insights, depending on what happens in the election, how it's going to affect taxes and so forth. We have Jay Rogers coming, an unbelievable individual. He's 3D printing autonomous cars and vehicles around the country. It's unbelievable what he's doing. CEO and founder, and he's actually launching self-driving vehicles in Jacksonville right around this time, and he's going to come join us and give an awesome speech. I got to spend a bunch of time with him a couple of weeks ago. It was really, really cool. Many other speakers as well, as myself and Bo and our team going to lead some pretty interesting discussion. So really encourage you to come join, take your mind out of the day-to-day, all the craziness, all the volatility, and focus in on building the legacy you want to build, focus on building wealth, focus on, getting some time to think about philanthropy, getting time to think about succession planning with your children, get time to stretch your mind, to focus on living fully, on fulfillment. It's going to be an awesome time. So really welcome you to reach out to us if any of this grabs your attention, you'd like to come join us. Not to mention, it's going to be November, and it's going to be 70s weather and beautiful here in Ponte Vedra, St. Augustine area. So another great reason to come join us. In addition to that event, we have we're looking at 3 other events. So in about a month, we're going to have a live and virtual. So we'll do it virtual just like we're all chatting right now. But we'll be hosting it live in Asheville, North Carolina at the Capitol Club rooftop restaurant. Anybody who can join us in Asheville, it's going to be an amazing place. At the highest point in downtown Asheville. And we'll have a live dinner event there. But again, you can join us virtually. And then 3 weeks after that, we'll be live in Bethlehem at the Arts Quest Center. Last time we were able to do this, right before COVID, we had an amazing turnout, about 500 investors joining us. We won't be able to have as many, so there will be real space restrictions at the locations due to the state mandates of amount of people that can be in a room and having to spread the tables out and all that. But that'll be in Bethlehem on the 29th. And then at the start of the Prosperity event, we'll have a dinner event on November 12th, that Thursday, here in Ponte Vedra, which, if you're not familiar, is right next to St. Augustine, which, if you're not familiar with that, right next to Jacksonville, is where Ponte Vedra, St. Augustine is located. Very easy to get here. Jacksonville Airport, one of the easiest airports to get in and out of. Super, super smooth, about 30 minutes from the location. All right. So to learn more about the upcoming events, to learn more about the housing fund, lending fund, get on the waiting list so we can get you deployed quickly, get you earning great returns. I'll reach out to any of my associates here you see on the screen. And with that said, I'm going to open it up for any questions, anything I covered, anything I didn't, anything you think I can provide you some insight and value on. The mic, or I should say chat box, is open, and Larry and Rich will ask your questions out.
Excellent. Thank you very much, Don. And again, reminder, you could throw your questions into the Q&A function or the chat box, and we're happy to answer them. So we'll go ahead and kick it off with the first question coming in from Haran. And Haran asks, in light of COVID and CDC freeze on rents, what's the worst risk based on in the future investments you're offering? And what's the likelihood of any hard times or even closing down the funds for the lending fund or the equity fund?
Yeah, great question. Thanks, Ron. And I guess I just realized I didn't really touch on how COVID's affecting us at this moment. It's been one of the kind of staples of these webinars. So that was a great question there to lead me into giving you some insights there. So I'll start with the lending side first. So on lending fund, I mentioned we've hit 11% plus returns through COVID. One of the reasons we've been able to be so strong in our returns is we've had no defaults. So I still, again, get to sit here and say, well, knock on wood here, we've had no defaults, meaning every borrower has made every payment. In lending fund alone, that's now over 400 loans. Every borrower has made every payment. We've deferred no payments. We have not done any forbearance agreements. We've had all of our borrowers make their payments through COVID. So we've had excellent performance. On the ownership side of our business, the real estate ownership side, we are, of course, as I'm sure nobody's going to be surprised or would expect, we are dealing with increased amount of delinquency. Certainly when you're in an environment where, we have record-breaking unemployment, and we have an environment where the courts were shut down and there were moratoriums on being able to evict residents who didn't pay, it created some challenges there. With that said, our team has performed at superhero levels out at our communities. They've worked with residents. They put them on payment plans. They've worked with voucher associations. They've worked with state and local organizations and state grants and programs that have been put in place as well. They've shown empathy to the residents while staying focused on needing to collect our rent. And so with all those efforts, we've averaged between 5.5% and low 6% delinquency through these last 5 months, 6 months now, which is certainly much higher than normal. But what's been able to offset that for us is that we've grown our physical occupancy by about 8% over the COVID environment since everything started. So we've increased occupancy so much that we've offset the lost revenue and debts that we haven't yet been able to collect, or rent that hasn't yet been paid. So we've actually thus far been able to generate better cash flow since COVID than pre-COVID due to the amazing growth in occupancy, because affordable apartments are an even greater demand in this environment. And we've treated our residents so well, they don't want to leave. So we're bringing in more residents. Our management team has stayed open, continue to lease. Our service team has continued to service residents. So we've been able to take a big proportion of people who are looking to move into our community. So we spent a lot of time and focus, especially since COVID, screening tenants, making sure they do still have jobs, making sure they have jobs that are likely to be there and through the volatility ahead. So we're doing a great job from that standpoint. So will we face more volatility if the government continues to create moratoriums? There's lots of talks on what's going to happen there. So, I guess some of you might hear about what CDC has said, and it's still being figured out what's going to get overturned, what's going to happen. Is there going to be moratoriums on evictions through the end of the year? Those moratoriums are only on evictions for non-rent payment, but what are the courts going to do? How are the judges going to look at things? Is there going to be aid to landlords or more state fundings to cover landlords? I mean, there's a lot of volatility there and a lot of open questions that nobody's ever dealt with before that we're all still figuring out. What I can tell you with confidence is I believe we've weathered the worst of things so far, and we've done so while actually increasing cash flow. So feel very confident that even if we go through another uptick of state shutdowns and moratoriums on rent, we're going to be able to weather through it and continue to generate cash flow. It might not be easy for us on the operating side, but we're prepared to fight through it.
Excellent. Thanks again, Don. And coming in from some of our social media questions, we have a question from Gene, which asks, why have rent collections and occupancy held up so far so well at DLP versus what's seen in other commercial real estate assets?
Yeah, so I'd say, and that was a good distinction there, because I'd say, we've definitely done a better job than average for sure. In that I think average rent collections in apartment communities have collected 91% of rent. So we're at, about 94%. So, and it varies based on asset class and geographic location. So we're, generally for same market, same type of asset, we've been 3 to 4% above, kind of what average management companies have been able to accomplish. Definitely proud of what we've been able to do. But in general, this asset class has had much better rent collections than all other asset classes. And that's, in part, is why we're in this strategy. And that you guys have heard me say for years, that we believe strongly that this space of affordable, and when I say affordable, I mean where rents are affordable to where the incomes are in that area, multifamily or housing outperforms every other asset class in recessionary environments and volatile environments. People need a place to live, and they need a place that's affordable, even more so when there's high unemployment, when there's a lack of security and volatility and all the tailwinds that come with recessionary environments that we're dealing with today in many regards. This asset class always does really well. And that's why big part of why we're in this space. So I'll start there, but certainly other asset classes, certainly retail and hospitality are the two, of course, that come to mind the most, have struggled tremendously as in a lot of areas as they've been forced to be shut down. Travel is optional. Going to physical stores is optional. We all know the trends that were happening way before COVID in terms of more and more retail being done via the internet. It's, this accelerated that in a lot of ways. Obviously, restaurants were forced to shut down in most cases for a significant amount of time. So a lot of asset classes have been affected much harsher with this COVID environment for sure. And those lenders who lend in those asset classes heavily have had to face and deal with a lot heavier delinquency and issues as well. So that's why we feel so strongly of being in this affordable investment housing space, today and for years to come.
Thanks, Don. Awesome. So we have a question from Drew, transitioning over to the lending fund side for a moment. He said, you mentioned previously that yields have likely hit their floor over the last couple of months. Can you talk more about your outlook for the next several months as it pertains to yield due to the current rate environment or the competitive environment, as well as your use of leverage in the fund?
Yeah, thanks, Drew. So right now we've been averaging low 11% yield in the lending fund over these last 3-4 months. The target of the fund is, I want to make sure I'm clear before I give the rest of the response, is 10%. So I tell you to come into the lending fund expecting 10% plus return on your money with liquidity and monthly distributions. And if you come in with that expectations, you're going to be very much pleased, I think, in the lending fund here. In terms of our ability to get our yields back up to where they've historically been, over 12%, there's a couple factors involved, and Drew mentioned a few of them. One is, the competitive environment, and if we don't have a lot of volatility and we don't have a lot of more of the issues that I think many think may happen with more shutdowns and, and depending on what happens in the election and all that kind of uncertainty, that hurts us from the competition standpoint, because that means the world of Wall Street is going to be in this space competing against us for borrowers and lowering pricing and increasing leverage. So the industry went very quickly. Many of our competitors went out of the business in March and April, or drastically increased pricing and cut their leverage. To very quickly, most of them are back to where they were pre-COVID. So right now it's, again, a very competitive environment. So we're doing a great job of growing and adding more borrowers and so forth despite that. But of course, that makes it harder to ramp up. And why that's important is, in order for us today to use more leverage, we have very, very low leverage. So if anybody's not familiar, we make loans, first position loans against real estate, and then we leverage some of our loans with banks at generally LIBOR plus 3 to 350. So we're making a loan at, basically 12% return, and then we're borrowing money at less than a 5% return. That gives a great spread that helps increase our returns. But right now, today, we're probably at our lowest point of leverage we've been at in the last couple of years. We're sub 20%, probably somewhere around 15%. And that's as we've had a lot of cash coming into the fund. We've been focusing to deploy your cash first before we're drawing on leverage. So as the volume grows in our lending, we will introduce and use more leverage, and that will help increase returns. Also, not having as much cash sitting will increase returns. So we're working hard. We'd like to get back up to 12% plus returns, but we're not going to take any undue risk. I mean, we could deploy every dollar of money by next Friday in all of our funds if we just lower our standards in terms of risk. We turn down so much business on the acquisition side and the lending side, or end up effectively turning down because the leverage points we offer are so low that operators choose to go elsewhere for their loans. But we're not willing to take any undue risk just to simply deploy money or to push up returns, 50 or 100 basis points. We'd like to do so. We expect as we continue. We started 5 new salespeople here in the last 2 weeks who are crushing it on the lending side. We're ramping up the sales team. We're ramping up borrower relationships. We have this big event coming in November, which brings all of our best borrowers together and helps us bring a lot of business. We're doing a lot of things to drive up revenue, but we're not gonna do is take in any additional risk.
Awesome. Thanks, Don. So Karine has a question. She said, we know that you can invest via IRAs in any of the funds, but can you expand a little bit about how UBIT or unrelated business income tax may come into play with any of the funds if you are investing through an IRA or other qualified account?
Yeah, thanks, Karine. So yes, you can invest in any of the DLP funds via qualified money, an IRA, 401k, et cetera. And the lending fund, frankly, is an incredible place to invest via qualified money and earn these kind of double-digit return sheltered from tax. The funds do not have any UBIT tax. So UBIT tax is when you earn income on the benefit of leverage, for short. But as a REIT, you're exempt from UBIT. And then they're also exempt because we don't actually take out any leverage at the fund level. We do it at a subsidiary entity level as well. So for a multitude of reasons, the short answer is there's no UBIT tax in any of our funds for qualified money. So nothing you have to worry about. I guess I'll say consult with your tax expert, but nobody has ever dealt with UBIT in any of our funds.
Excellent. Thank you very much again, Don. So moving on, a question from Rory. Does DLP manage all properties internally, or do you outsource to property management? And how will you manage the large acquired portfolio if you double your size?
Thanks, Maury. So in short, I think about management in three pieces. I think about it: asset management, property management, and construction management are the three kind of pieces of real estate management. Those are the three divisions of DLP real estate management. So we 100% do all asset management in-house. We 100% do all of our construction management in-house. And then we do 90% of our property management in-house. We have certain properties, whether it be they're in a geographic location where we're not best suited to provide the best on-the-ground staff to manage that property, or we have a partner who we own the property with, who has their own management team, who we allow them to do the on-the-site management, but then we sit over top of them as the asset manager, and then we do the construction management. So the vast majority, we do all the above. In all cases, we do the asset management and the construction management. With this large acquisition of nearly 12,000 apartments, we will actually be acquiring the management company along with the portfolio. So we'd be acquiring the on-site teams that work at the properties, the asset managers, the construction teams, the accounting teams, the IT team, the HR, the whole organization, and which it will be over 300 team members. Our plan there is we'll actually run that management company separate from DLP Real Estate Management for a period of time, probably 4 to 6 months, so we can focus on onboarding the assets, and all that work. And then, 4 to 6 months later, when we rebrand all the communities and we've done a lot of I'll call facelift a lot of the communities, we'll then rebrand the management company and merge them into DLP Real Estate Management into one management company. So in short, we'll be doing the management, we'll be acquiring the property management company, and they'll all be reporting to our senior team. But it'll be kind of a two-step process to make them all part of DLP Real Estate Management.
Excellent. Thanks. And staying in line with the large acquisition, we have another question that asks, will your new large acquisition create synergies which will reduce management costs, administrative and otherwise?
Yeah, absolutely. I mean, that's the age-old story of M&A is the redundancies that get created when you merge two similar companies, in this case portfolios, together. You're going to have some redundancies that you're going to be able to cut out. It's going to drive better efficiency. And as you can see here, this portfolio, our portfolio today is in 19 states. The portfolio we're acquiring is in 9 states. And so we have a very broad geographic location to where our properties are located. So as you build more density, it allows you to build your regional, we call them directors of operations, who are our regional property manager who oversees a local portfolio. We have regional project leaders on the construction management side, a regional asset manager, investment manager. So the more you can have a portfolio denser together, the easier it is to be able to manage it. When your regional manager, whether it be construction or property or asset or investment, can get to the property, every property in 2 or 3 hours, meaning they can drive to any property and get there and be there the same day, potentially go to 2 properties in the same day. It creates a lot of efficiencies in better utilizing their time, having them better controls over the assets, and also saving a lot of money in airfare and travel and so forth. So a lot of value that's going to come not just from this portfolio, but just in general, as we grow our portfolio and we build more density in the markets we're in, it drives a lot of efficiency, which will cut down costs, and even as important or even more importantly, drive up overall performance.
Excellent. Thank you very much. And switching now to the lending side, I have a question from Chris asking what happens when a borrower isn't able to pay off a loan if his buyer gets delayed on their loan?
Yeah, so we do most of our loans essentially at a 6-month term. So we're giving a borrower a loan for 6 months. We do them as long as 12 months, but typically it's a 6-month loan. It's very, very common. The way I always think about it, these aren't exact figures, but this is the way I think about it. We do a 6-month loan. We know there's a 50% chance that that borrower is going to need an extension, generally 90 days. So half the loans we write, we're going to have to give them another 90 days. Out of the loans we give that 90-day extension, half of those loans need a second 90-day extension. And probably if I took that a step further, probably half of those need another extension. Just, there's a million different reasons to why a project doesn't get fully done in 6 months. And a common one could be that example. Somebody could buy a property, fully renovate it, get it on the market, get it under contract, have a buyer. And then not only could that buyer's financing get delayed, but that buyer could lose their job and now the buyer can't buy and they got to go back on the market and resell it again and re-go through that closing process. Probably everybody in this call has been through that themselves on their own personal homes at one point or another. So that's part of the business. It takes some time. So we know that going into it. And we're always, for any borrowers making their payments, taking care of the property, we're always willing to give them more time in order to, execute on their business plan.
Excellent. So sticking with the lending fund, a question in from Pat. What is the difference between a hard money lender and the bridge lending that DLP does?
Yeah, it's a great question. So you can use the term if you wanted to say, what we do at DLP lending, you could say it's hard money lending. That's a term people will use for this type of business. But I think of what we do is very different to what Pat said there than hard money lending. So I think of hard money lending. I think a lot of people, when you hear that term, what you think of is you're making a loan to somebody who's in a hard spot, right? That's why they call it hard money lending. This guy has no options. He's down and out. He needs this $100,000. He needs it by next Thursday, or he's going to lose the property to foreclosure, or something bad's going to happen. You can charge him whatever you want because he's in desperation, and when you make that loan, there's a great chance that you're going to end up owning the real estate. I call that a bad news loan. Our lending is lending to a guy who's generally buying. The vast majority of our loans are new purchases, improving a property with a business plan that's going to generate a profit. So this guy is not in desperation. Generally, he has 700 plus credit score. Generally, he has a few $1 million net worth. Generally, has a lot of experience and a lot of liquidity. And we're giving the loan for the purpose of buying a property, improving it, and selling it, or buying a property, improving it, renting it, and refinancing us out. So it's a good news loan. We're giving him a loan to make a profit.
Excellent. So I'm going to go to a couple of the quicker questions here since we're starting to run up on our time. And so the first question is from Mo, and he wants to know what keeps you up at night.
What keeps me up at night, from a business standpoint or personal standpoint or any otherwise, nothing. I mean, so my latency, as they call it, I wear an Aurora ring, which tracks your latency, is under 1 minute to fall asleep. So my head hits the pillow and I'm out. And I'll tell a little personal information. I have 2 small dogs, 2 golden doodles, who my wife was convinced to let sleep in the bed a few months ago. So every now and then they wake me up at night. And that's a new thing for us. But other than that, in all seriousness, no, nothing keeps me up. I mean, we've built an organization with a lot of discipline, with a lot of structure, and a tremendous amount of great people. So there's certainly challenges and obstacles that we face every day here at DLP. Dealing with thousands, and I say thousands, we have 25,000 plus residents living in our properties, having nearly 1,000 by next week, 1,000 plus investors that have entrusted their capital to us, having hundreds of borrowers who we lend to and help grow their business, having nearly 400 team members who we support and who count on us here to continue to do what we do to support their families and so forth is an amazing responsibility and honor. But it certainly doesn't keep me up. might keep me up, and then I'm working late into the night at times to keep on top of all the exciting things we have going on. But other than that, I sleep very well at night.
Excellent. I do as well, so that's a good sign. All right, so we're going to go with two-part question here from Arthur. One's a quick one, which was, will the prosperity event be online? I'll let you answer that, and then ask the second part of the question that Arthur is asking here.
That's a great question. So all the dinners that I mentioned, the one in Asheville in October and end of October, Pennsylvania, and then the dinner event here in Ponte Vedra, St. Augustine, November 12th, those will all be virtual. You'll be able to join via Zoom or social media as well as live. In terms of the prosperity event itself, I don't think we have that exact answer yet. We're debating it yet. If there's a COVID spike up of some sort and we couldn't do it live, which we're certainly not expecting, we will move it to a virtual event. But assuming we're able to do it live, which believe me, we're moving full steam with that expectation and belief, and that we'll be doing this event fully live. I don't think we're going to do it. We're going to stream the whole thing. We may stream certain segments, but the way it's going to be moving, I don't know if we're going to be able to kind of stream it in a focused format virtually. We'll be recording the whole thing and like to be able to provide recordings, but I don't know if we'll be streaming the whole thing live. We might stream some of the key speeches and such. We're still figuring that out, but that's a great question.
Excellent. Thanks, Don. And then Arthur would also like to know, what do you see as the impact on DLP business if Biden wins the election?
I'll just say, I don't get too into stressing about politics to be frank. I just think no matter what happens with elections, it's never as dramatic as anybody thinks, good or bad. It's never the end of the world. It never, nobody ever actually does, good or bad, what they say they're going to do when they're trying to win an election. And things don't move that fast in the government. So, I don't think no matter what happens, anything happens, overnight. And statistically, give you a positive note here, statistically, first-term presidents, the economy always outperforms second-term presidents. It's been true again and again and again and again. I don't know if it's been true every time, but nearly every time that's been true. So that's a nice, I think, positive sentiment for whatever that is, whether it's Democrat or Republican. Markets always perform better in first-term elections, so or nearly always. So that's a nice positive note way I think about it. But I don't think they have the effect that a lot think. I think there's some things that, and this is stuff we'll be talking about the prosperity membership. I think the bigger effect to think about is if things such as the lifetime exemption on gifting could go away, or there could be changes on capital gains, things like that, tax rates. I think those things have slower but can have meaningful effects that you need to be thinking about from a tax standpoint. I think that's the real big change that can come and change in policy is tax changes that can affect a lot of us. But and I would definitely be conscious of, and we'll definitely be, depending on what happens in November, we'll definitely be talking a lot at the prosperity event. And then also, in these types of settings as well, we'll bring some experts in as that gets closer. If there is going to be a tax plan change, I'll commit to you guys here. I haven't really thought about this, but I'll commit here that we'll make sure to bring one of our tax experts on to share, insights and perspectives on potential changes to tax plans and how you should plan for that in this type of format as well.
Excellent. And sticking with the theme of a little politics, not that it's too political, but a question from Haran is, are you or do you anticipate lobbying at all to save rents and rental payments with your local elected officials?
Yeah, that's a great question. So I know a lot of our leaders are actively involved in organizations like the National we're members of organizations like the National Housing Multifamily Conference. It's or multifamily. I don't know if it's organization, but it's the largest organization out there for National Housing Multifamily organization. And all the top, kind of management companies and owners, or at least most, are members. And there's a bunch of discussion and lobbying going on there. So we're supporting those efforts and are actively engaged. Our in-house legal team's actively engaged in understanding what's being proposed and being involved in advocating for landlords. So short answer, I guess, is yes. Long answer, I don't know. what in the scheme of things right now, what the lobbying is going to affect and what the outcomes are going to be. But yes, we intend to try to make an impact any way we can in some of these potential policies.
Excellent. So that's all the questions we have in our queue for today. Any parting words you'd like to leave our audience with today, Don?
I'll just say, and I don't know if I couldn't check if you didn't already drop it in, Larry, Rich, drop in the event link, and you can always just go to dlpcapitalpartners.com, go to our main website and click on events, and please register to join us. Come join us live at any of these upcoming events. Please, if it all piqued your interest, think about coming and joining us at the Prosperity event. And at worst, we'll be chatting again here virtually with you at worst on October 8th, where we'll be doing that though live from Asheville. And look forward to again, we're chatting then, and appreciate all your time sticking with us here today, and all the support you've provided to us here in this crazy 2020.
Excellent. Thank you very much, and have a blessed afternoon, everyone.
Thanks, everybody.